Are you making a very common but completely avoidable taxable account mistake? Now, when we enter retirement, we have different tax buckets. We have a tax-free bucket that would include Roth IRAs and HSAs. We have a tax-deferred bucket, including traditional IRAs. And then we have our third bucket, our taxable account bucket. Now, accounts that fit into this bucket would be a joint account, individual account, often referred to as a brokerage account or a non-qualified account, community property account, trust accounts. All of these type of accounts fit within this taxable account bucket. Now, within our retirement, we can utilize each of these buckets to get the most out of our plan. But what I see a lot of times is retirees losing value out of this taxable account bucket because it ends up being a very leaky bucket. And because it can be a leaky bucket, it requires more focus. And so in this video today, we're going to be talking about a given tax drag, a leaky hole within that bucket that we need to make sure that we patch in order to gain the most wealth out of this given bucket. And so we're going to be talking about the cost of something called turnover tax drag on your wealth and how you can avoid it within your retirement. So let's hit the ground running. So at any point when we put money away for our retirement, there is some point where we're going to be paying taxes, or maybe multiple points where we're going to be paying taxes. When we contribute to something like a Roth IRA, we are agreeing to pay taxes on the contribution in order to not pay taxes in the other two phases. During growth, we have tax-protected, tax-free growth. And then at the withdrawal point, we have tax-free withdrawals. Well, a tax-deferred account basically works the opposite way. We avoid taxes, we defer taxes on the contribution, we defer taxes during growth, and then when we ultimately withdraw money, we pay taxes on the withdrawal. Now, the reason a taxable account can be a leaky bucket is because in the other two accounts, we're basically having tax-protected growth. In a taxable account, we don't have tax-protected growth. And so being taxed during the growth phase, we'll see as we go through this video, can drastically drag down our performance. Anytime there is a taxable event created in our taxable account, whether that's from selling a given investment and buying a different investment, that's something called turnover. We're turning over part of our account in order to sell investment A and buy investment B, let's say. Or anytime there's something like a dividend. Okay, these are all taxable events. We are forced to take a dividend. We have to pay taxes on that dividend. And then if we're reinvesting, we have tax drag. So when we're being taxed during this growth phase, okay, we are translating that to tax drag because that taxable event we're having to pay taxes on, and now we have less money working for us for the future. On the screen right now, I have a hypothetical example, and I'm showing a taxable account with no drag over here on the left-hand side, and then a taxable account with what I would call turnover drag. And so what we're looking at here is in both examples, we're looking at the exact same performance, 7% growth rate. We're looking at the exact same tax rate, 15% long-term capital gains rate. The difference with the taxable account with turnover drag is we're turning over our account every 2 years. Basically what I'm meaning here is every 2 years we're switching our investments from investment A to investment B. 2 years later we're switching it to investment C. 2 years later we're switching it to investment D, and so on through these 10 years. Every 2 years we're completely changing out our investments, creating a taxable event, and thus paying out taxes. Those taxes paid out can no longer compound for our future. And so what we see because of that is there is a tax drag due to turnover. Okay, so on the left-hand side of the screen right now, we're looking at a taxable account that we're not making any changes to. It's a very buy and hold account, if you will. There's no drag with this given account. We're just earning 7% each and every year. And through this 10-year period, you'll notice that this account has risen to $196,715. And so from this account, we have a cost basis that we've already paid taxes on to get the money into this account of $100,000. We then have $96,715,000 of unrealized growth. And so to translate this to after-tax wealth, we're going to, in a hypothetical situation here, basically turn over this entire account at the end and pay 15% in taxes on this $96,715 worth of growth. That leads to an after-tax amount of $182,208. Now in this other example right here, we're looking at a taxable account, again, with that 100% turnover. We're turning over our entire account, creating a taxable event every 2 years here. And so what you're going to see is we still start with 100,000. We still grow it at 12. And so what you'll see here is every 2 years, we have a taxable event that creates taxes in this given column over here in the red. And so as our account grows bigger and bigger, we'll notice that it translates to more taxes. But basically what's happening here is we have $100,000 that's growing to $107,000. It's then growing to $114,490, but then we're turning over our account at the end of the second year here. And so $2,174 is leaving our situation, and we now have net after-tax value at the end of these 2 years of $112,317. And we're doing the same thing every 2 years, where we're turning over our account, paying out taxes, and so now less is compounding for our future. Now, by the time we get to the end, because we've been continually updating our cost basis and creating those taxable events, the amount that we end with is actually our after-tax wealth here of $178,738. And so comparing apples to apples, looking at the cost of this turnover drag, we can see that not turning over our account, not having any taxable events within our account, leads to higher after-tax wealth versus having continual taxable events. And so this is why we harp on so much within your taxable account that we need to be able to control our taxable events. We need to control our tax liability, because we know anytime there is a taxable event, it is money leaving our situation. It's no longer compounding for us for the future, and there is a given tax drag. Now, there is a very important distinction here that I want to make sure that we make. We previously recorded a video talking about dividend tax drag, and whether it's a turnover of your account, whether it's dividends within your account, both of those are taxable events that lead to a given tax drag. Now, the very important distinction here is if we're taking that taxable event as income, there isn't a tax drag. Tax drag only comes from when we're reinvesting that taxable account. And so whether it's from a dividend standpoint or whether it's from turnover of your account, if you're taking that turnover, that taxable event, or you're taking that dividend as income, there is no tax drag. There's only tax drag that occurs when we're reinvesting that for the future. And the reason being, again, is because you're taking that taxable event, you're paying out taxes, and you're reinvesting less. But what I want to show over time is the overall cost of this turnover tax drag to your situation. And so we're looking at full liquidation value. And so what this means here, as we start comparing different turnover rates that you may have within your taxable account, within your situation, we're looking at the after-tax liquidation. And so previously, as we just showed in this previous example, basically what this means is at the end, the ending value that we have, we're completely eliminating the unrealized gain, we're paying taxes on it in order to make an apples-to-apples comparison. Obviously, with turnover, we're constantly updating our cost basis. So if we're not updating to after-tax liquidation amount, we're not comparing apples to apples. But nonetheless, when we look at the impact of turnover drag, we're going to look at it at varying turnover rates. So first off, we're looking at a $100,000 portfolio growing at 10% per year for 20 years. And we're looking at varying turnover rates. So in the first example here, we're assuming no turnover, meaning that this is a perfectly managed investment here. We don't have dividends leaving this account. We don't have any turnover. We're just simply buying and holding for the future. And $100,000 turns into just under $590,000. Well, then at each subsequent turnover rate, whether it's 10% turnover, 25%, 50%, 75%, or 100% turnover on an annual basis, we see the cost of this tax drag here. So for instance, 10% turnover means that you have a $100,000 account and you're switching 10% of your account from one investment to the other. You're turning over that account. We see the difference between having no turnover within your account and at every subsequent turnover rate. Okay, at the most extreme rate, turning over your account each and every year, we see that this person ends up, and we can see this on the y-axis here to the right, we see that this person ends up with over 12% less money within their taxable account. Now, this is looking at a 15% long-term capital gains rate. What you'll notice is the higher that we push that given long-term capital gains rate, the bigger cost that turnover tax drag has on your situation. So when we update this to having net investment income tax, that's an extra 3.8% surtax for single filers when you show AGI above $200,000. For married filers, when you show AGI above $250,000, you have an extra 3.8% surtax on long-term capital gains. When we look at a higher long-term capital gains rate, what you'll see is turnover gets more costly. So before looking at 10% turnover essentially costs you about 5 to 6% in overall wealth within this account. Looking at 10% turnover at a higher long-term capital gains rate, we see costs you over 6%, right around that 6 to 7% range. And 100% turnover previously cost you around 12 to 13%. Now it's costing you over 14%. So the higher long-term capital gains rate that you pay, the bigger impact that turnover drag has on your situation. Well, the opposite is also true. If you're able to realize long-term capital gains at a 0% marginal rate, then we may actually want to be turning over your account. Because again, we're updating our cost basis at no cost. So if you happen to be in that elusive zone of that 0% long-term capital gains rate, well, then it might make sense for you to have turnover. There is no turnover drag at that point. So it's very important, again, to make that distinction as well. And so how can you avoid tax drag within your taxable accounts? Well, as I previously mentioned, we've recorded a lot of videos on how to set up your taxable account properly in order to patch all of the leaky holes that bucket can have. We previously recorded a video around 5 taxable account rules that you need to follow in order to avoid tax drag. I'll link to that up in the right upper hand corner here. Now, when we look at these 5 taxable account rules, 3 of these taxable account rules will translate to this given turnover drag that we see. And so I'm actually going to go in reverse order. It will make sense here in a second why I'm going in reverse order. But the first one is don't actively trade. And by definition, if you're actively trading, you're creating turnover within your situation and thus translating that to turnover tax drag. So if we're on a regular basis, we're changing in and out of investments, all things being equal, there is a tax drag. There's a tax cost to that. And so ideally, we want to be a little bit more buy and hold within our taxable account. Number 2, don't hold bonds or fixed interest investments. The reason being is because that, by definition, creates a taxable event each and every year. The interest that you receive is taxed at actually ordinary income rates, not even long-term capital gains rates. And so we see turnover tax drag have an even higher cost. And then finally, don't hold mutual funds. Again, our goal here is to have complete control over your tax return. Well, when you hold a mutual fund, the mutual fund manager controls your tax return. The reason being is because that mutual fund manager is buying and selling given investments inside of this mutual fund. Well, a mutual fund is a pass-through entity. So any buying and selling that happens is passed through to you, the end investor. And so what you'll notice with mutual funds is you have this nice surprise at the end of the year called a year-end capital distribution. There is a capital gain that mutual fund passes to its investors. And so on an ongoing basis, that capital gain distribution is the exact same as turning over that portion of your account. And so again, holding mutual funds will cause you to have a higher turnover drag through time versus holding more tax preference assets. What would be some more tax preference assets? Well, holding individual investments would be slightly more tax preference. Holding ETFs as well would be more tax preference. And so let's go through an example of exactly what I mean here. And so mutual funds will have a built-in tax drag that you will see. And this is due to the structural differences between a mutual fund and an ETF. A mutual fund is a pass-through entity. So any changes that are made, that given capital gain distribution is passed through to you, the investor. And so we're just using a given mutual fund. You will notice across mutual funds, some are more tax efficient, some are less tax efficient. We're using one that's fairly middle of the road here, called MFS Growth Mutual Fund. And this is going to be a large cap growth mutual fund. And in 2021, we see from its given distributions, it distributed a decent amount of long-term capital gains here. The total amount of long-term capital gains is $5.37. Now that $5.37 doesn't mean a whole lot to us as investors. We need to compare that to the overall share price of that given mutual fund. And so I'm using the last share price here at the end of the year, or of the last distribution of $175.95. And so when we divide $5.37 of this 2021 distribution by $175.95 of the share price, we see that 3% of this mutual fund was forced as a distribution to investors. And so at the very least, with no other changes within this person's account, if they held this mutual fund, they would have a 3% turnover drag because they're being forced to have a taxable event that they otherwise would want to have. ETFs are much more tax efficient than mutual funds. And so they could own something like Schwab US Large Cap Growth, and both of these are US Large Cap Growth funds, but the ETF is going to be much more tax efficient. But we see dividend distributions here of a total of 69 cents. Now again, 69 cents doesn't mean a whole lot in terms of a distribution. We have to compare that to the share price. We're going to use the ending share price at the end of the year of $165.03. And so when we translate and approximate the entire distribution for the year, percentage distribution, we look at 0.41% forced income. And so with ETFs, it's not as if they're perfectly tax efficient. There are very few investments that you could put within your taxable account that will be perfectly tax efficient. But we can make steps towards being more tax efficient. And again, you will see on an ongoing basis, ETFs, when compared on a general basis to mutual funds, are significantly more tax efficient. And so holding ETFs or even individual investments within your taxable account and buying and holding those investments, all things being equal, will deliver much lower tax drag to your situation. Now, you may be someone that's sitting here watching a few of our taxable account videos, and looking at your current taxable account portfolio and thinking, wow, I have some fairly tax inefficient investments within that account. And I can see why there is a tax drag on my future. But the problem is I have some large unrealized gains within this taxable account. And leading back to all of the things that we discussed, if we make a change and go from tax inefficient funds to more tax efficient funds, yes, there is an improvement by going to those tax efficient funds, but there's also a cost. Because again, by definition, we're turning over our account. So everything we've talked about in this video so far, by changing up things within our account, by building a more tax efficient portfolio, we're subjecting ourselves to a given tax drag. And so there must be a break even that we'll see in the future from exiting a portfolio that is less tax efficient and updating it to a more tax efficient portfolio. What is the break even between there? And as with most things, it depends. It depends greatly on your situation. So it depends on what long-term capital gains rates or short-term capital gains rates you might be paying right now versus what you can pay in the future. How long will you be investing in that given account? If we're liquidating that account, let's say next year, because we're paying conversion taxes or using that as income, well, then there may not be a benefit to updating to a more tax efficient portfolio just for 1 year. And so there's all of these different things that we need to consider. Now, we will record an additional video talking through break evens and how you should be thinking through this. So make sure you subscribe to our channel if you want to see that next video where we talk through the break even between exiting a tax inefficient portfolio and updating to a tax efficient portfolio. But the big message here is know that it depends on your situation. There are a lot of things that you have to weigh. But the overall message here is that if you're turning over your account, whether from you actively trading or whether from a mutual fund delivering capital gains on a regular basis, there is a tax drag to that given turnover. There is a tax drag to dividends. There is a tax drag to turnover. There is a tax drag anytime you are creating a taxable event within your situation. If you are paying a given tax rate on that taxable event, there will be a tax drag. Now, the first step in retirement is identifying that you have a problem. Second step is fixing that problem. Now, hopefully in this video, we've identified that problem. We've talked through a few different ways that you can fix it. Now, ultimately, the best way to fix it in your situation will vary depending on your situation. But understanding that there is a tax drag, understanding that you can fix that tax drag will translate to more wealth in your situation over the long term. Hopefully this was an informational video. Always remember that you don't need more money, you need a better plan. If you like this video, the best thing that you can do is hit the like button down below to help other retirees just like yourself hopefully find value out of this video, as well as hit the subscribe button so that you're notified of all future videos that we release, like the break even between updating a less tax efficient portfolio to a more tax efficient portfolio. We appreciate you taking the time to watch this video and improve your retirement. We hope to see you in the next video. Have a great rest of the day.